All right. So the question is to scale out or to exit at once. In front of us is a crude oil. It's a 60-minute, and as you can see, it's the current date here is August 12th, 2024. Now, why crude oil? We want to answer the question, is it best to scale out? And I figured we'd look at, besides the S&P, another commodity market that was relatively volatile. Instead of going straight up and then one week of maybe 3 weeks of decline, this is a market that has all types of ups and downs, sideways, as I will share with you going back. I went back almost approximately 2.5 months. So there's a lot of trades, and in this, I think it's fair to say the market went up, it went sideways, it went up, it went down, it went up, it went down, it went up, it went down and up and down and then up. So we've got both sides of the ticket here. So you don't look at a strategy in a market that goes straight up and say, how's the performance? You need, so I wanted to take a random volatile market and say, all right, if you're buying in the market, what's the best strategy? Getting out of everything all at once or scaling out? This model, we used 2 contracts. The model on your right gets in and gets out all at one price. The model on the left gets in all at once and scales out of half and then trails a stop on the balance. So if you're, depending on your trailing stop function, this particular model is still long half of the strategy. In other words, it gets into 2 contracts. It got into 2 contracts right here. It got out of one, and it's trailing the balance of the position. So the question is, again, when asked, what's the best strategy? Get in all at once or get out all at once? So I'm going to go through some of the things on our algo optimizer for you and give you, without much more ado, let's just get into the data and I'll look at the strategy performance results with you. Here's the position for the chart on the right is the strategy that gets in all at once and gets out of everything all at once. This particular model did not get out of anything. The model to our left got out of half the position, almost at the exact time. So the entries are very similar. They're the same entry model. The difference in this model is the exit. So what suits a customer better? Now, again, this is a small random test, but it's crude oil. It's been volatile. Let's take a look at the results. So the performance summary shows the profit factor is 2.4. It's taken almost, ironically, equal amount of longs versus shorts. A little more on the short side, 37 trades on the short side. Profit factor is a little bit better on the short side, and that might help you to uncover the notion that markets go down farther and faster than they go up sometimes. And so that kind of gives that kind of credibility. Bottom line, $37,180 total net profit, both longs and shorts combined. All right, interesting. Now, what about the one that allows us to trail a stop, get out of half the position, and trail a stop? How did that do? It actually did worse. It didn't do much worse. It's pretty close. It's a very similar model, but you would think, wait a minute, this didn't give us the same or allow us for those runners. I mean, here's a situation. Now, maybe it'll do a little bit better depending on where it exits, but here's a situation that you can clearly see when it gets into a trade, it gets out of the trade. Sometimes it gets out of the intended profit target and then trails the balance. And I think for the majority of people will do a little bit more research on this. This isn't the end of the set in stone model, so to speak, that says don't ever scale out. But I think it does kind of allude to the fact that when you look at a strategy to get in and you're looking to get out, it depends on the exit and what the trailing stop functions is. So bottom line, the trailing stop function here uses a last conditional change technique, and I'll go through some of those with you right now. So we go to studies, edit the strategy. This is the algo optimizer. We wrote this program and on using trade station technology. So let me explain the system dynamics a little bit. This particular model, both models, they both trade 24 hours. So you can day trade at the Asian market, you can day trade the Globex hours, you could day trade the open outcry. If you only wanted to day trade specific times, I can actually say, I want to trade any program from 2 a.m. until maybe 5 a.m. But we're not going to do that right now. I'm just going to walk you through. I'm just telling you what's capable of what we built. Position sizing, we're doing 2 contracts. Position sizing is 2 contracts, both models. And here's what's just so that you can see what the scale out ratio is 0. It doesn't get out of half the position, it gets out of all. Gets in all, gets out of all. All right, so now let's take a look at the position strategy to the right, just to make sure that we're fair and impartial here. So we're going to go to Studies, Edit Strategy, open up the File tab. Here we go. Trades 24 hours, trades 2 contracts. There it is. And here it is. Scale out at half and then set a stop at break even on partial profits. So bottom line, if something happened, you got out of half the position and it fell all the way back, at the very least, if nothing happened, it's got an emergency stop to get out of half the position. And as you can tell, when we go back and look at the performance, once again, 36,000, scaling out, 37,000, getting all out at once. We'll do some more of these, but it would be interesting. This is what we'll be building in our 2-day seminar here in South Florida. Bottom line is I use TradeStation for building different strategies, and we use that information when we get that data, for example. And some of the things that will be helpful to uncover is what's the average holding period? What's the average net profit? How many bars does it take on average for what's the average winning trade, longs versus shorts? Longs are actually making more money in this model than the shorts. So there's how many bottom line, largest winner of gross profit. So it's not like one trade made money. As you can clearly see, and I just want to point this out to you, a red line, it went long here and got stopped out. So a connecting of a line of red means it's a losing trade. The little blue dashed lines means it connects the dot of where it got long, where it got out, and if it's a blue dashed line like this one short, it got stopped out there on a trailing stop function. And so connecting the dots blue means it's a winning trade, or at least it had a successful outcome, all right? So these are the things, one other thing that we like to look at is what's the return on capital, buy and hold return, 1.66, annual rate of return, or at least return on the account is over, in this particular model, and this is educational in nature, just to explain what were the results of scaling out of half a position on 2 lots in the futures while day trading versus getting out of everything at your intended profit or a trailing stop. Bottom line, it makes a little bit more, and really, I think over time, maybe one day might be satisfying to trail your stop and let a runner go. But on average, getting out of everything all at once still provided in this segment of time for this market for that particular time frame. So there's a lot of buts and ifs. Just to point out, a very volatile market, interesting topic of conversation. What's better, getting out of everything or getting out of half? And in this particular model, the answer was getting out of half. And this is the kind of stuff that the development and market analysis that we like to do to help traders train themselves to make better odds in anticipation of market movements. And be honest, this is exactly the kind of thing that we get into on our seminars. If you're interested in finding out more, then obviously go to visitpersonsplanet.com. I hope this information serves you well, and at least a quick answer to what are the market's dynamics in recent history and how do systems perform. So once again, you take a look, we have a strategy performance. There is a very systematic, not all trades are winners. You can clearly see a green dot. This means that a little slight drawdown. Again, same story over here. Less of a drawdown, but this particular model did a little bit better on profitability by not, and repeat, not scaling out. Thanks for watching. I hope you enjoyed this educational format, and we'll do more of these as the weeks